What are we talking about today, Eric? Roth conversions?
Yeah. Not just Roth conversions. Let's really talk through the nitty gritty here, because people are just so adamant about saying, hey, we need to do Roth conversions. Or some people just saying the opposite. I hate hearing about Roth conversions. So let's just kind of talk through this a bit. How do we even look for it as advisors, figure this out, and show you what we're looking for? So then now you can kind of, if you're doing it on your own, figure that out. Or if you're looking for an advisor,
Jazz Wealth. So I like to get geeky about this stuff, and I know a lot of videos are like, well, this is what a Roth conversion is, and here's how it works. I'm going to assume that you guys know this already. So now we're going to go into, should you do it? What's the difference, and how does this all work? So we're going to use Louis and Lucille Armstrong here. And the first, I've already kind of done a little of the work. I don't want to make this a whole overview on how the process works, but I want to show what we're actually achieving in this case.
And by the way, at the end of this video, we're going to have a couple more questions. So it's a new format we're doing. So I just wanted to make sure I let people know if you're clicking off, you got 2 questions at the end.
Do the questions have to do with conversions, or are they a surprise?
Different.
No? They're different.
Different questions.
Okay.
Yeah.
Oh, great.
I always bring in the surprise questions that Cody
Just
gets
to
me
see.
off of YouTube. So
All right.
yeah.
Okay, so here we've got Louis and Lucille Armstrong, and what we're in the, you're on the right one. What we're looking at, you just got the green and then the blue, right? So the green is if we do the conversions, the blue is if we do not. So what this is, starting off a little basic, what this is showing is, hey, we're going to fill up what is currently the 22% tax bracket and what will be the 25% tax bracket, unless Kamala wins. And then, so you have that top of that bracket, and that's all it is. If we wanted to fill up the next bracket, you would see it go up there, and so on, right? So in this case, based on the types of accounts this person has, if we wanted to convert 100% of the money in each year, but did not want to go over the top of that bracket, this is just telling us how to do that. That's sort of general. Yeah. Now, if you go to the Details tab, and then...
Real quick, just to add into here on this, something that a lot of people get stuck on when you're talking about Roth conversions. I'll give you 2 myths, in a sense, just looking at this scenario right here. The first one is, they get hung up on, you'd mentioned, what did you say, the 22 to 25% tax bracket. They get stuck thinking, well, if I do conversions, that means that every penny I have is going to be taxed now at 22 to 25%. That is not the case. The way this works is, if you look, tax brackets are tiered. So you're going to have a certain amount taxed at, let's say, 10%, another bit taxed a little bit higher, and it incrementally goes up. So you're not just taxed at a blanket rate, because if you actually look, there's different types of looking at taxes here. You've got your ordinary tax bracket. That's your bracket. But what you're actually looking at, what's the term I'm looking for here of?
Effective tax rate.
Effective, that's the word I was looking for, and I was actually looking on here. It used to be on here, I don't know.
Well, it'd be on, we have to make this an actual plan first, but on their dashboard, it would actually say their effective tax rate based on this plan, which is, this year their effective rate would be 10.2%. Now, they're still working, they're not retired.
Prior to the conversions. So what I'm saying is, if you're converting to 25%, you may actually have an effective rate, meaning your overall average is like 17%. So that's one myth. The other myth with this, just giving you an idea, is that you're getting stuck on how much you can convert, because people look at the Roth IRA and they say, well, I'm limited to only doing $7,000 or $8,000 a year, depending on your age in 2024. That's not factual either, because you can convert as much as you want. This is not considered a contribution. You're taking from the IRA, putting it in the Roth. Now you just have to pay taxes on that whole amount. So that's just a couple things there. I'll let you get back in on your details.
Maybe add another one is you can do a conversion and then still contribute up to the max.
Yeah.
Because they're considered 2 transactions.
Yep.
So
yeah, people get really confused on those.
Well, so speaking of the actual tax you would pay, let's look at it this way. So on let's say this year they decide to convert. Well, if you hover over this little guy there, their adjusted taxable income, if they don't do a conversion, is $108,499. If we start trying to get up to the top of that bracket, you see we hit $200,050, which is the top of the bracket for 22%. So we're essentially saying, I will pay the tax now versus, let's say, when you get to RMDs and they're forcing you to take it out. So let's compare the two. If you go to the Details tab and we say Tax Details on the drop-down, perfect. The fourth column over, total federal tax paid, if we did this, is going to be $34,571. Now, some of that is from their income and their normal taxes they would pay. Some is going to be because of the conversion. So we got $34,571 We go to the retirement tab at the top and look at their cash flows. Let's compare the difference between what they were going to pay and what they would pay in the future, just as for fun, just to see if we're off base here.
Yeah.
So this year, their tax payment is going to be $24,155, and we don't have the conversion modeled in there. So let's say they don't do the conversion, they wait and go, oh, it's RMD time, I got to take the money out. If we scroll down to age 75, now it's more money that they're taking out in this case, but they still have other income, likely Social Security, and I think they have royalties of some kind. And now we're forced to take out $128,000, where our tax bill, well, you know, it's close to it's $32,859. So it's that same 34, right? All we're doing now is saying pay it now versus later, and again, with their effective tax rate presumably being somewhat low still, remember it's 17%, let's say, and they're 54 years old. 17%. How long to make back that 17%? It's not an easy answer because we don't know how they're invested, but that's what we're doing. We're just essentially switching one tax bill for the other, and hopefully, in this case, saving a lot of money.
Yeah, and in this scenario, I mean, you're on the cash flows there. The older you get, the more the government's going to require you to take out if you don't do the Roth conversions. And there are clients who come to mind who are just at a point where now they're taking so much in RMDs. We didn't work together prior to the age they are now. Well, they're at a point where there's really no sense in doing the Roth conversions. And so they're just having to take out these RMDs, and it's just crushing them, not only on the RMDs, but also on the IRMA tax that comes into play. Now, when you're talking the RMDs though, or not RMDs, but the Roth conversions, what you really have to think through, and what I talk to clients about is you've got, looking at this in multiple scenarios. Maybe you're a single filing individual and you're wanting to spend the bulk of your assets early on, and once Social Security hits, you want the go-go years to just fly, and they say, hey, you know what, I'm going to take Social Security at 70, I'm going to live it up until then. If you're spending down a lot of your assets, you're in a higher tax bracket by spending down your assets, you may not need to look at the Roth conversions. I'm seeing that a lot oftentimes in the single filers if they're spending the money early in the plan. If you're hoarding the cash, you're going to get smoked on the RMDs later on. So you've got to figure out that balance there for your scenario. For the married filing jointly, a couple different ways to look at this. You can look at, well, what's the best for us just in general, but you're also wanting to look at the what if. What if one of the two spouses passes away early? If that were to happen, that's what do they call that? The ticking time bomb. It's not, no, it's
widow's tax
torpedo. There you go. Widow's tax torpedo. So calling it that, the reality is that you're going to have a much higher RMD because now they're having to take their RMD plus your own RMD. And so with that, that's going to push all of the taxes much higher. And also your Medicare premiums will probably go up as well because that's a whole different bracket that you have to look at there. So there's that. Then you've got the idea of, hey, let's look at these conversions really for the sake of estate planning and inheritance. That's another scenario to look at because if you have kids and you're saying, hey, you know what, I want to leave my kids, $1 million tax-free. Well, potentially it's worth doing that and just doing the conversions and getting it out of the way. On the other side of that, it really depends on your children and what tax bracket they are actually going to be in. So this isn't just like a throw the dart and say, hey, this is what you should do, or you see the video that's telling you, you must do Roth conversions. There are times where it does not make sense for you. With the new inherited IRA rules, they have to take the money out within 10 years. With that, oftentimes the Roth conversions do make sense if your child's in a high bracket because it's going to really push their income a lot higher if they're set to inherit a lot of money. But that, again, is not always the case. Maybe your child is, in a 10% bracket and you're going to leave them $400,000. They can space that out over 10 years. They may be in a better position just doing that than you actually doing it now and paying the tax. A lot of different things to look at.
Hopefully you're getting asked that question if you're with an advisor or whatever, where if they say you should do a conversion, great. Tell me how that money gets spent in the future. So for example, this year we had that conversion. How much was the conversion this year if we filled up the bracket? It was like $100,000, right? So we go to distributions tabs, details, and we're going to see withdrawal and conversion. It was $92,212, right? So we go, okay, that's $92,000. Well, you're not spending it now, or they're not spending it now because they're 54. They're not planning to retire, I think, until 63 in their case. So are we using that money then? Well, no, probably not. You're probably using the remaining IRA money if you haven't converted at all, or some brokerage account money, whatever. So you may not be using that money till later in life. Well, what does it look like then, right? So make sure you're getting them to see that picture. And then the second thing that he alluded to was you're not going to, in this case, these people will convert more money than they'll ever spend in their lives because after growth and everything. So someone should be asking you, the leftover dollars, if we do this, who is that going to? Is your daughter or whatever some high-powered attorney or something that pays a lot of money? Well then, yeah, let's keep going. But if you're, I mean, I always pick on the artists, but like if your daughter or son is like an aspiring artist, and that takes a while to build a reputation and all, so they're gonna have low income, you're projected to be like 95, so you may not be here. Well, let's not convert that money. Let's put the tax to them. It's what's the effective tax rate for you, low as possible, versus what's the effective tax rate for them if they end up inheriting the money. So a little different way to do it. And I did the math real quick. It was exactly 17.07% would be their effective tax rate if they did that this year.
Yeah, so looking at that and figuring that is something you have to think through. And then to get even just one more notch geeky here is thinking through, well, also in the RMD years, what is your plan with that money? If you have a lot more money coming in than you need and you're wanting to do something called qualified charitable distributions, QCD, that's a whole nother level of planning that we could look at to think through to see if these Roth conversions work. What is your money going to at the end of life? Like you say, is it going to a child in a high bracket, lower bracket, or are you planning to donate that to a charity? Because if so, the charity gets that tax-free regardless, whether it's coming out of an IRA or a Roth. If you're not planning to use those Roth dollars anyways, and it's all going to a charity, that's a whole nother take on this. So it's not a one-size-fits-all, I think, is what the argument comes down to on that one.
We could even do something where we just use different examples and keep doing videos like this, because it really is different for different people. Yeah. And I'm going to get a little grumpy for a second. My main, here we go.
Oh, here we go.
My main reason for doing this for people, like my main drive in life, is exactly what we just heard the other day. The reason why I do this, I heard the government say, and I won't say which side, but they said they were talking about the unrealized capital gains.
Right.
And so
somebody got upset about it. It's only over $100 million. No, but it's only over $100
we're not
million.
even going to bother doing that. They admitted that they're not going to do it. And they said, but we have to find other revenue sources.
Yeah.
Why?
Well, they're talking about now taxing 28% if you have $1 million or more. But on capital gains. But the American dream is to build a business, somebody sell the business for $3 million, and it's like, okay, great. Now you're paying 28 versus 20.
My argument is that they constantly say we need to find other revenue sources. That's a fancy way of saying we spent all the money. Okay, let's go back to how you're spending the money
every time
and figure it out, right? Because if I'm short on money, I got my budget, I'm doing my thing, and I find out I'm going to be short, I'm not going to go find other revenue sources. You can only do that so much. How much can you work? So you go back and you go, well, I'm going to cut out the gym. I'll do push-ups. I don't know. You figure things out. Why can't they go back and go, hey, let's just talk about that budget for a while?
Regardless of side, they all spend too much money.
Both of them do. So besides, and the reason that drives me is because I want to give them as least amount as possible. So if this means you pay them less money and you put it in your pocket, you'll spend it better than they will. And I think everybody agrees with that, whether you're Republican, Democrat, Independent, who cares?
And the person that was upset about the comment, well, it's only $100 million and all that, we were just talking about the complexity of taxing unrealized gains. It just doesn't work. That was the whole thing there. All right, let's get on these questions. All right, so if the S&P average is roughly 10% a year, yes, some big downturns, but some big upturns as well, why not just always stay in the S&P, even in retirement?
I actually saw that question.
Yeah.
That's a really good question.
It's a great question.
And for a younger person, you go, well, if it's always there and it's never going to disappear and it always goes up over time, then why don't I just stay in it? There are a handful of reasons there. I'll take one of them. I don't know if you have an idea, but this is the geeky side of it. It's called sequence of returns risk, right? And if you were to do that, just plain Jane, you were to just go all in and just whatever, and if it's up 21%, great, I had a good year. If it's down 10, whatever. That's what we're worried about, is when you're withdrawing from a declining account, now the next time it goes up, you have less shares of that. Yep. So my combat to that would be to say, if you're really smooth about this and you're into it, then if you want to do this, in the years that we have greater than the 10% return, whatever that extra percent is towards the end of the year, assuming we have it, take it out and put it in a money market. Right now, a money market fund. So you'll still have about 5% return, but you won't have that downside risk. Then I'm assuming if it all works out perfectly for you, in those down years, when oh crap, I can't withdraw or I don't want to, hopefully you have a little bucket over there. So it starts to make a little bucket strategy. I wouldn't do it, but Can it be done? I give it
Yeah,
enough
and
time.
the younger person, I mean, I think there's definitely an argument for one way or the other on the S&P 500 if you wanted to do that. If you're investing in a brokerage account, the one issue we see with that is that you're investing into an index or an index fund or an ETF. You're not going to get any kind of opportunity to take losses and gains on that portfolio, because whatever you get is what you get. So if there's any plan to withdraw money and play any tax game, that's not there. I love what you said, because that really comes down to like the retirement years. And we alluded to this the other day on our last podcast, was really just talking through the idea that you're in a position where when you retire, you may have been aggressive your whole life. And for whatever reason, this switch oftentimes flips and you're like, man, I can't handle these ups and downs as much now. I thought I was good, but I'm not. Because when you have $1 million, when you do have the large pullback years, let's say 25%, now you have $750,000. That's where you've really got to find what the comfort level is for you, and then also the sequence of returns. The only reason you would stay in the S&P is if you wanted to say, okay, I'm going to take $1 million, I'm going to do the 4% rule. Okay, you're taking 40,000 out. But now when you have 750,000, you're taking 4% of that. That's a lot less income. So you got to realize that you're going to have a lot less income in those years if you were going to be able to do that and make it sustain and you need not lose it.
You'll need a great rally from there to bring you back to a point, because you have less shares. So that's a cool question, though, because they're thinking volatility. They're thinking like, I don't care what it does. Mm-hmm. Well, maybe you don't care how it moves, but when you go to withdraw, it's going to add up.
And if you really want to get crazy on that, and you're younger, why not consider the NASDAQ? Look at the NASDAQ. Talk about volatility, but the mix run that it's had here recently. Yeah. So QQQ is an ETF that's just out there. It's very popular, gets advertised all the time, but that's stuff like that. All right, I got one more for you. Still confused. So my mom left me and my sister about $139,000 in an inherited IRA, which is now sitting at Schwab. Number one, sorry to hear about your mom's passing. Number two, it's great. At least your mom, was able to leave you some money, so that's awesome. All right. So do I just need to withdraw that amount of money before the 10-year expires, take out $5,000 for 8 years, and then take the biggest portion once I'm retired and in a lower bracket? Or is there a formula somewhere that says you need to withdraw 11%, as an example, a year until depleted? I can kind of easily break this one down for you. So I love the way you're thinking, number one. But the IRS did just come out and require you now to take required minimum distributions off of these inherited IRAs. So if you have the 10 years, you obviously inherited this account 2020 or after. So you're going to have to start taking the money out based on the required minimum distribution. Being that it's $139,000, that's not going to be a significant amount. There's a good possibility you may be able to get $5,000 a year out for those few years and then take the larger portions in retirement. Just depends. So just check on, you can look up calculators, find what your required minimum distributions are going to be. That's what you're going to have to take. And just know that, just as you say, you've got to deplete it within that 10-year period.
Because of the recent rule change, I think we actually cut this part out and make it its own separate video. Because there's a lot missing in that question that we now need to know, and we didn't need to know just a couple weeks ago.
Yeah.
So when did you inherit the account? Let's say it was 2022, right? All right. How old was your mom at that period? Was she taking RMDs already, or did she not make it that far? If she was taking RMDs already, then you continue to take the RMD based on her lifespan, right? That was the one they just messed up. If she was not taking RMDs, now you have to take RMDs based on your time, life table.
There you go. Yep.
And
good clarification there.
In 2022, 2023, and they're not doing it this year, right? They're not waiving the RMDs this year? They're not this year. So
gosh, I think they were this year, but then I don't know.
Okay.
I don't know. It's been such a mess with the IRS the whole time, and I've got to look back at it.
So let's say that they're waiving them this year, and just don't count on me for that one. I don't know. So let's say you inherited in 2022, 23, you didn't have to take anything out. 24, you might not have to take anything out. Well, what's the lifespan? Let's say you have to do your life. What can I think of the name? Life table? Time?
Mortality
table. So do you go, well, hey, I'm so many years old, I look at the table, and at 22.3. No, you have to go back to 2022 when you inherited the account.
So true.
Use your lifespan for that. So all those little specifics, I'm kind of fascinated by them, but it's such a mess right now that question actually can't be answered based on the data we have. You'd have to say, I need to know date of death of mom, and I need to know, date of death of mom, and was she taking RMDs or not?
Yeah. No, that's
tricky.
Yeah, very, very valid points on that. All right, so my obese parent, I typed this in wrong too. darn it, this is gonna mess up the whole
Cut.
joke.
Try
Now
again.
it's like
Let's hit it again.
my obese parrot passed away last week. I'm sad, but I must say it was a huge weight off my shoulders.
That's tricky for you. Good job. Damn, I want to kind of go with a joke that follows along with that, but I'll save it because I'm trying to get a joke that we can put in.
Oh, okay.
You know, so I'm going to go with this one today. What do you call a Mexican who has lost his car? Carlos.
Carlos.
To all my Spanish people out there, huh?
Carlos.
But otherwise, I would say, what's the biggest city in America? Obesity.
Right? I think you've said that before.
I did. That's why I wanted to kind of come over here.
I think.
Did it.
Yeah.
I did it. Hey, well, thanks for watching. Hope you learned something. There was a lot to learn here today. I know that was a more in-depth one. Do you like the more in-depth videos, or do you want us to just sit here and argue with each other? Let us know in the comments below. We'll be happy to do it. Thanks for watching. Subscribe. Check us out at jazzwealth.com. All that good stuff. Adios.
Adios.